Dear investor, in this edition, let us look at the markets at a new all-time high. We will look at which part of the market has done relatively better in terms of market cap cohorts, where the relative performance may lie going forward and the reasons for the same. Having a look at macros as well and our reasons for believing we could see a period of consolidation in the market, and yes, the valuations. With that, coming to the first topic, Indian market measured by Nifty has just crossed its previous all-time high. However, the previous high was over 6 months back, and in the interim, earnings have compounded, which has made valuations today 6 to 7% lower than the last time index was at the same level. And that does mean we could see a consolidation kind of a period. That's a higher probability than any correction kind of a period. Over this period, different sections of the market have performed differently. Mid-cap index had crossed 32,500 levels in November of 21 and again came close to the same level in December 22. However, versus that, it is now trading 10% higher, more or less preserving valuations versus the earlier high. Nifty, which had made previous highs during similar periods, is just about achieving its peak. And there, as we noted earlier, corrected for valuation for earnings compounding, we have seen a valuation. We are seeing a lower valuation as of now. Past period thus has been favorable for mid-cap companies, and it is seen in the performance of the space, and we have been pointing out the same. Some of the reasons are as follows. One, policy environment has been very pro-growth. From COVID lows, we have seen the government roll out policy initiatives like Make in India, defense indigenization, rolling out of PLI benefits across sectors, sourcing cheaper Russian crude, ethanol policy, etc., and has also provided for import duty protection. India has been a beneficiary of the global sentiment to diversify supply chains away from India. Banking sector has also seen strong growth in AUM and a low NPA as a consequence of continued positive policy momentum, which has resulted in improved corporate profitability and employment opportunities. So all of this is leading to improved macros, improved situation at the banks. While the policies benefit businesses across the market cap, but for larger market cap companies, the benefits are relatively smaller given their size. While smaller cap beneficiaries have quickly moved to the mid cap range. The key beneficiaries hence lie in the mid-cap space. With the disruptive environment of the past period now normalizing, the performance of the mid-cap part should continue after a period of consolidation. So we do expect this part to continue to deliver relative outperformance. Coming down to the next topic, macro situation, we do believe it is less favorable versus the last time did this. As was widely expected after successive rounds of increasing interest rates, with inflation coming down, the US policymakers paused rate increase while keeping a hawkish stance. Let us look at it like this. China, which is the factory of the world, has seen inflation drop to low levels, as has India, which is the service provider to the world. If both of our countries, see a drop in inflation, well, sooner than later, US should also expect to see a drop in inflation. However, in the interim, because of El Nino concerns, lower rainfalls could happen, and that could result in another spike in prices, which may be on the minds of the policymakers. Now markets now expect another up to 50 bp of rate increase in the US, and US 10-year has moved up by around 30 bps. Continued increase in the US interest rates would mean that RBI may also have to wait for longer before cutting interest rates. As yet, Indian policymakers continue to enjoy higher policy independence because our forex reserves are comfortably high and stable. That said, our 10-year yields have also moved up. Point to note is that we believe if inflation drops and remains low, we could see a change in stance of the policymakers. Higher interest rates are a headwind for growth assets. Now we are looking at a conjunction of a market peak and higher yields. Again, a reason for us to believe markets could consolidate for some time. On the positive side, Q1 numbers should be better than expectations. On withdrawal of, let's say, one reason is withdrawal of 2000 rupee currency notes. People are either spending them, bringing some amount of cheer on the retail side, or are exchanging them. Spending should result in better than expected sales for corporate India, while already bank deposits have moved into surplus liquidity situation as a consequence of people putting in money. Coming down to the next thought, and this is something we have been sharing in several of our past editions, we believe it continues to be time for alpha. The positive policy making environment has been great for the mid cap space, as we have noted earlier. This has meant that the outlook for continued alpha generation is strong. While there can be a pause for a period of time, newer spaces such as new tech, engineering, benefiting from focus again on manufacturing, defense, on indigenization, and with newer opportunities opening up globally. Hospitals, we are a country which is seeing the senior age cohorts seeing strong growth. Chemicals on China +1, EMS also on China +1, and yes, capital market players on market up move have all been introduced in the market, and many are seeing sustained positive business tailwinds. Since these spaces are not present in any large weight in the larger cap indices, performance in these spaces provides alpha tailwinds if the funds are positioned in the same. As we had described earlier, we are a house where we have identified these themes, and all the funds strongly represent these themes with respect to the market. While this is happening, at the same time, the top end of the index, we see headwinds of consolidation / regime change in larger banks, and a slowdown in IT services in the large IT companies as a result of global slowdown. Commodity companies should also continue to face some amount of headwinds on account of continued policy focus on inflation, which is like negative sentiment for commodities. Now, with a significant part of the index facing headwinds thus, and sustained growth in many other spaces, themes as we described above, alpha generation should be good and strong for managers going forward. With markets at a high, let us see how the markets have shaped up over a period of time, over 2 decades, and also for the near term. Over a period of time, when the market moved from one peak to the other, we have seen derivative volumes move up sharply versus cash market. While derivative volumes have been strong and are gaining the volume share, cash volumes have also been buoyant over a period of time. From a 8 trillion annual market volumes in 2002, cash market volumes have expanded to 143 trillion in financial 23. While these are trends for the longer term, in the short term also we have seen derivative volumes expand and margin funded trade book increase. This should be watched. A cut in the market gets accelerated on account of leverage which has to be taken out of the system. That said, in terms of number of active demat accounts and new account openings, the pace has slackened. This is good and healthy because typically at a market peak, many more new investors are expected to get sucked in, and happily this does not seem to be the case this time. If we track the net inflow into mutual funds, again an interesting pattern comes out. We have seen stronger net inflows into mutual funds during period of a market drop versus when markets are buoyant. So 2 months back, when markets were less buoyant, we saw strong net inflows into mutual funds on the equity side. Last month, when markets were buoyant, that inflow dropped substantially. This does indicate that domestic investor has come of age and has modulated investing patterns to benefit from market volatility. Coming down to the next topic on valuations. Our construct for year-end market level is a range of 18.5 multiple to a year-end index EPS. Index EPS on 24 could be 900 and around 950 for Nifty, and for 25 it could be around 1100 range. This implies a March end target for Nifty to be in the 19,500 to 20,000 range, around just about double-digit return from the present, theoretically speaking. This implies less than 1% a month of index compounding, and again leads us to hence expect a period of consolidation in the market. The other reason why we expect markets to consolidate. We continue to be focused on the growth themes as shared in the last edition, such as China Plus One, health infrastructure, new tech, software services, mid-cap software services companies focused on growth verticals. So it is not across the board, it is a very, very bottom-up kind of positioning. Retail-oriented banks where growth will sustain, etc. We believe that as we go forward and economic recovery normalizes, generating sizable growth on a sustainable basis would become more difficult, and companies which are able to do so will command a premium, as used to be the case earlier, providing tailwinds to our high quality, high growth style of investing. Any reduction in yields as a consequence of lower inflation, for example, or slower economic growth, or any other reason, would also provide tailwinds to this style, and we do expect this to play out over the second half of the year. With that, thank you, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.